Welcome to This Week in Money. I'm Jim Goddard. Ross Clark from chartsandmarkets.com runs down the major markets. They bounced back a bit, but will the rally continue? Ross has a special offer for our listeners. Longtime BC stock trader Victor Adair gives us his take on why crude prices fell so fast. We ask if he's surprised that gold has fallen since Russia attacked Ukraine, and he has some investment advice. Rick Ackerman, editor of Rick's Picks, believes inflation is close to ending its run, and we could fall into the dark world of deflation, and how U.S. social safety nets are made from rotten cotton. Rick also offers you a deal to join his newsletter. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Yeah, it's a pleasure to be back with you, Jim.
Ross, after it seemed to be a pretty bumpy start to the summer on the stock markets, a bit of a recovery this week. What's the story there?
Yeah, well, the employment numbers at the end of the week are pretty strong. But for me, I always look at the technicals. And when the big picture here, the Dow, the S&P, and the NASDAQ, if we look at the monthly charts, they have oversold readings that are quite rare. We've got 9 examples going back all the way to 1981. So you're talking over 40 years where we've been as oversold as this on the monthly charts. And each one of those examples produced a reasonable low. About a third of them were coming off a top. They were sort of the first leg down where they had a bounce, and the retracement rally was 50% of the initial decline. The other 2/3 became a resumption of the methodical uptrends. And we will look at the refined look of where things were at around the bottoms. A double or a triple bottom is very, very common. There are a couple of V bottoms, I think. What if I look at my numbers here? It's two V bottoms. The rest are more of a low and then a retest of the low. So what we've had at this point is the oversold low. We're getting a nice bounce right now. So if we were to go back down and retest the low as close to it, or maybe undercut it and make a turn, we could get a fairly decent rally out of this, and definitely a playable rally for any of the traders.
What's happening with crude?
Crude oil into a consolidation phase. This was the prime item for everybody to be in for the last couple of months. After having missed the big run, they finally decided, we better be on board. And the reality of it is that what you're getting is fairly broad trading ranges. You're getting days with 7 to 10% trading ranges, either up or down. This is, it's going to take a little while to resolve itself. At this point, the uptrends appear to still be in motion, but it's going to take a lot of patience to sit around and see how this thing evolves.
Has gold decided that it's going to stop its fall yet?
Yeah, there's a combination here of things going on when we take a look at it. You get gold and silver, good hard sell-offs into new lows for silver, and gold's holding just above recent lows. And on the other side of the equation, you've got a very strong U.S. dollar, which closed at a new monthly high on Friday. And the resolution of this one is that I think you'll see a pretty decent bounce in the precious metals. Not looking for new highs or anything, but a decent rally here that would coincide with a pullback in the dollar index. Dollar index is definitely in need of correction at this point. And so if you've been on board the move, which has been holding at the longer-term moving averages on each one of these breaks, I think it would be time to lighten up right here.
The Canadian dollar, I know we always compare it to the U.S. dollar, trading around 78 cents, 77 cents. But on the worldwide picture, if you put the Canuck buck up against anything else, it's doing relatively well.
Yeah, it's holding in here quite nicely, you always, when you're talking about anything that you want to measure, in particular like a currency, you've got to be careful about what you're measuring it against. As an example, we take a look at gold in the various currencies, and other than the U.S. dollar, gold market's having a pretty good year. As far as Canada is concerned, because it's got this marginal erosion in price from, we were at 80 or 81 cents this time last year, and we're now down to 77.5. So anybody who's been long in the precious metals has seen, maybe a 5% move in there. Nothing big, but decently well supported during the breaks. And as you say, if you look at it against other currencies as well, it's doing very well.
Ross, before we go, you do have a special offer for our listeners.
Yes, that's right. We're offering 25% off on an annual subscription for new users. That will be 25% for a limited time, and that would be available on the homepage of the website at chartsandmarkets.com.
Ross, thank you so much for being on This Week in Money.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on Twitter at chartsbyross. Coming up, Victor Adair next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Victor Adair. Recently retired from nearly 50 years of being in the brokerage business in BC, but still very active in the markets. Check out his website, victoradair.ca. Welcome back to the show, Victor.
Jim, it's always fun to visit with you. Thank you.
Victor, the price of crude took a huge drop this week. By Wednesday, it was down nearly $20 from last week's highs. Then it bounced back about $10 by Friday. Analysts have been telling us that crude is in short supply. If that's the case, how could it drop so fast, so quickly?
Well, let's see. I think the short answer to that would be it was the energy market, but crude in particular, were sort of the last man standing this spring. I mean, we had the stock market. I think the S&P at one point, which had made its all-time highs the first couple of days in January, was down about 26% or so. Other markets, we had interest rates had gone up and up and up. Then I think a lot of people saw the energy market, which, by the way, was the dog in the equity markets last year, the energy sector. A lot of people got into the energy market. I think it got to be a very crowded trade to be long energy, and as I say, the last man standing, other things were falling away, and people maybe started to take profits on energy. Just, gee whiz, this is up, maybe it's going to fall too. Markets are talking about recession looming. The story, the narrative, or whatever term you want to use, that had supported getting crude oil up to, like $130 a barrel post the Russian invasion of the Ukraine, the story really boiled down to there's a shortage of supply. There's a lot of nuances to that, but that was the nuts and bolts of it. And there just, there was no way that we were not going to have higher prices would be if there was demand destruction of some kind, because the supply was just it's shortages. And I think maybe one of the old terms is people got too far out over their skis, like everybody and his dog sort of believed that story. And I mean, me too. It was a very well documented story. And then when everybody got into something, and then some selling started, and there's been a backdrop just generally, I think, in the markets of uncertainty. There's a lot of moving parts going on here. It just fell. I mean, I'm watching it on my screen. Like, holy mackerel! Look at that. There's another dollar. I mean, it's down another $2 in another 5 minutes or something like that. So we did peel off very quickly. It bounced back maybe $10 at the end of the week, but we're still probably about $20 below below the highs of this year. Another way of looking at it would be wholesale gasoline prices. Now, everybody was focused on how expensive it was to fill up the car. Wholesale gasoline prices from the highs that we touched in, say, early mid-June to the lows we had this past week, we're down about 25%. That's wholesale gasoline. That wasn't showing up yet, in the filling stations where you go to get your car gassed up. But yeah, we had a market that had a very powerful run to the upside while other markets were getting battered, and all of a sudden, the crude oil market got hit. There will be people, and I've read some of the analyst reports, that'll argue there's a huge difference between what they call the physical market and the paper market, where we trade stuff in the futures markets. And yeah, I'll go with that. But if you've got a position long in the futures market of WTI and it's down $20, and you're not expecting that, you probably have some tough decisions to make, or the margin clerk may be making them for you. So could be a hodgepodge of different things that pressure prices. And I'll see this not only in crude, but across the board in the commodity sector or even the futures market sector, where open interest, the number of contracts that people are willing to hold overnight in a number of markets, from the S&P to crude oil to gasoline to wheat to corn to what have you, cotton, open interest is down at multi-year and in some cases multi-decade lows, because the short-term price action is so wicked and so choppy. Liquidity is just not there with the uncertainty, so it just exacerbates the move. So, a whole bunch of things, like I've just listed here, kind of contributed to that very sharp break we had in the energy markets last week. And I think not the least of which, by the way, was the fact that natural gas in the U.S. had run up to, I guess, about the highest level prices we'd seen since around 2012, 13, something like that, because they were trying to ship a lot of natural gas, turning it into LNG and shipping over to Europe, because prices were so high over there, demand was so strong, it boosted the American market. Then we had a facility in Texas blow up, and they couldn't ship the gas, and all of a sudden the price of natural gas peeled off about 30% in the U.S., and I think that might have led to some switching from oil to nat gas, and all of a sudden there wasn't the bid in oil that there had been before. I don't want to pretend or get into, all of the nuances here, but markets are volatile. These are wicked markets, and you just got to be careful. One day it's one thing, the other day it's something else.
Speaking of energy, I see farmers in Holland shutting down the country in protest over fuel shortages and new rules designed to put them out of business. For some reason, they're going after nitrogen emissions. Who knew nitrogen was a problem? Makes up most of our air. It seems to be pretty important news with Holland's farmers, agriculture, their biggest industry, I believe. Yet the mainstream media in Canada isn't reporting on it. What are your thoughts there?
Well, this is part of the background environment we live in, and let me put it this way. It seems as though the authorities, okay, let's call it the governments, the central banks, whatever, the structures that we have that hold us, hold our society together, they seem to be floundering, okay? I mean, there's been a boatload of problems, and the guys at the top seem to be struggling to be able to deal with these problems. And, you know, I think the people, we can use that term, that aren't the authorities, see that the real issues are inflation, particularly, you know, rising food and energy costs. And we're getting demonstrations of different kinds. I mean, who can forget the truckers convoy here in Canada? And you know, I certainly in my own mind was cheering them on. I think, go give them shit, guys. I mean, you know, that it seemed like there was like a level of arrogance, maybe, or worse at the top, and the authorities weren't getting the message. But we have these protests of different kinds all over. The Dutch farmers thing is just huge. I mean, they are really shutting down the country with their tractors. No supplies on the grocery store shelves. And now that German farmers are getting into it, there's serious protests in Italy. Boris Johnson, the Prime Minister in the UK, just resigned. Biden, I mean, God bless him. I mean, he just seems to be stumbling as he heads into the midterms coming up in November. And then on the central bank side, they were, you know, just embarrassing at how slow central banks, and not just the United States, okay? The Canadians seem to be just as slow here to acknowledge that inflation was a problem. And, you know, we got the war in Ukraine and so on and so on. I mean, there is a high level of uncertainty in the markets that I trade, I think, because of this, let's call it, maybe just even a lack of trust in authorities, or certainly the trust, you know, that they know what they're doing. And I think it's hard to quantify how that shows up in prices, but I know it shows up in behavior of people in the financial markets.
Yeah, reading up on that Dutch protest, the government wants to buy out thousands of farmers. We always thought farming was a sustainable industry, and turn that farmland into housing. And here in British Columbia, we have the Agricultural Reserve, which prevents farmland, which is very rare in BC, really. We're mostly mountains and ocean, into industrial or housing property. Why do you think Holland has decided that farmers are evil? Don't they like food?
Yeah, well, I think without trying to specifically answer that question, I'd just say that there is, I think, a broadening of the suspicion that the authorities don't know what they're doing, or they've just got a different agenda, and of course that shows up in different ways with different people. I mean, there's some folks that look at the World Economic Forum as being true socialists, communists, whatever. We could spend way too much time on that for right now. But the uncertainty, the lack of trust, maybe, in those folks who think they're running the show, is also showing up in markets.
The weakness in commodities is across the board. Everything from crude to copper to corn has been falling. What's your perspective?
Yeah, I mean, the Economist magazine, a wonderful magazine. I think they've been publishing it for 150 years or thereabouts. I mean, just has this habit over the years of putting something on their cover which marks the turning point in a market. And just recently here, I guess in the middle of May, they put a picture of a couple of pieces of wheat, like still growing, and the headline story was to the effect of the coming catastrophe, like we're all going to starve to death for lack of food. And I think that was almost to the day when the wheat market turned around and fell like a stone for the next little while. The copper market, copper's probably even more interesting. I mean, we went through a narrative buildup in copper that the world was going to electrify in ways we hadn't ever seen before. There was going to be an incredible demand for copper, and there just simply wasn't enough of it to go around. And it took, God knows, 10 years to find a potential copper mine, go through the permitting process, and actually get it into production. If you could get approval from the authorities who didn't want any mines in their jurisdiction, and on and on and on. So it looked like, copper was going to be a layup, buy copper, wear diamonds. Then copper has had a tremendous fall. And so, what happened to that story about copper was, going to be so bullish? So let me be a little bit cynical, but also reasonable with you. As a trader over the years, I increasingly don't believe in anything. And I don't mean I'm cynical. I just go, well, there's this story and there's that story. I don't know which one may turn out to be true, if probably neither one of them. On the same basis, when I think in terms of I don't believe in any stories, I mean, I do read a lot of research. I try to pay attention to a lot of things, and that's probably as much as anything to get a handle on, what I think the crowd in the market believes to be true. Well, if you believe that the market's going to go up and up and up, and it does, you probably buy more and more and more. And then when it starts to go down, you just think, well, this is a correction, and, maybe it gets worse. So I try not to believe that I know what's going to happen, okay, or that anybody else does. I just look at what is happening and try to trade off of that. So, yeah, we've had a weakness in commodities across the board, and it's been the strongest sector of the market for the last several months, and probably just got ahead of itself and, needed a correction. So that's my perspective on that.
Since January last year, you've been bullish on the U.S. dollar in every one of our interviews. You still bullish?
Well, I just got done saying, that I don't believe in anything, and try not to get myself into a spot where I take a position and it goes against me and I get stubborn with it because I believe in something. Okay, having said that, the trend is your friend in almost any market. And you can be suspicious of something, like I certainly was suspicious late last year that the stock market was getting way too frothy. Just absolute junk was getting bid up with billion-dollar market caps, and it wasn't just the stock market. There were other unlisted markets that had that same kind of go-go mentality. But the U.S. dollar is where capital goes when people get worried. I've said, I think, more than once on your show that money flows to the U.S. dollar for safety and for opportunity. And given the uncertainty in the world, the U.S. dollar gets bid. The United States is of the major, relatively safe countries where you can put some money. Their interest rates are higher than most. So you can get a return on your capital. There's still, relative to some other countries, more freedom to do what you like to do in the United States, and so on. So, and it may also, by the way, there's people that, and I understand their stories, that say it's not worth the paper it's printed on. And I say, well, I hear you, but if we're talking currency trading, then it's, do you want the U.S. dollar or the euro or the Japanese yen or the Turkish lira, or, and of that, if that's where my choice is limited, I'm going to pick the U.S. dollar. It seems like maybe, it's gone too far, too fast. One of my expressions that I've had for more than 40 years, I used to be a currency analyst for a worldwide commodity trading firm, And one of the things I used to say was that the trends in the currency markets just go way further than seems to make any sense. And then they turn on a dime and go the other way. And the turning on a dime kind of makes the point that they had gone too far that way, and therefore they turned on a dime. The euro right now, just this past week, has broken down to a new 20-year low against the U.S. dollar. And you look at, let's call it, all the problems and everything that's wrong with what's going on in Europe, and you say, gee, well, I'm not surprised. The Japanese yen is at a 24-year low against the U.S. dollar. The Canadian dollar, by the way, is at a 7-year high against the euro and at a 14-year high against the Japanese yen. So, Canada is maybe looking weak against the U.S. dollar, but compared to the rest of the world, Canada looks pretty good from a currency trading perspective. So, yeah, I think maybe the last time you asked me that question, I said, depends on your time frame, and maybe that gave me a little wiggle room, but that's also, I believe that, if I'm looking to put a trade on tomorrow, am I going to be a buyer or a seller of the U.S. dollar? Part of me is going to say, this thing has gone so far so fast, it's tough to buy it here, but, it's like a freight train. I don't want to stand in front of it.
Gold has fallen nearly $350 from all-time highs made following the Russian invasion of Ukraine. With all the uncertainties in the world, are you surprised that gold's been so weak?
Yes, short answer. Gold's had two big enemies this year. This is gold in U.S. dollar terms, by the way. And maybe before I forget about that, I'll just say gold in terms of most other currencies is at all-time highs. Now, to come back to where we were, in the U.S. dollar terms, it's down $350. Well, the U.S. dollar is the strongest currency in the world. It's not surprising, I guess, that some other currencies, gold looks pretty good. The two main enemies for gold, the two toxic things for gold are typically a real strong U.S. dollar and interest rates rising, and particularly real interest rates. Those two things taken together have really been kryptonite for the gold market. Now, we did touch an all-time high in nominal terms in gold after the Russians invaded the Ukraine, and particularly it was the week that they started putting sanctions on Russia. And it's been sort of down, down, down since then. I think we touched a 10-month low this week. I bought some gold on Friday for the first time in a while, just thinking it was so oversold that it was worth a buy. And then going into the weekend, I thought, I don't think this is such a good idea. I'm trying to catch the falling piano here. Yeah, I think gold is probably weaker than it should be, but I'm just going to get flat, and I can always buy it back again on Monday. Is sort of my attitude. That's gold bullion. Silver has been worse. And we were at a 2-year low on silver at $19. That's down about 30% from the highs we had in March on silver. And the gold share index, the GTX, for instance, the ETF, that's at a 28-month low, down about 38% from the highs it hit in March. So, yeah, gold's been really clobbered. It's weaker than I would have thought, given the uncertainties that we have, that I've just talked about, the lack of trust in the authorities and so on. I mean, if there's anything that would typically, at least in theory, put a bid into the gold market, it would be if people seriously begin to not have trust in the authorities. So, yeah, I would not be interested in shorting gold here, and I might take another look at buying it next week.
The U.S. 10-year Treasury bond yield hit a 12-year high a month ago, but interest rates have fallen since then, despite expectations that central banks in Canada and the U.S. will be raising rates over the next several months. What's happening in the interest rate market?
Well, there's some ebb and flow, surely. We had the 10-year yield on the U.S. Bond hit the lifetime, no, more than a lifetime, many lifetime lows in August of 2020. We got down to 0.5% yield. The high on the yield recently was I guess the day that the Federal Reserve met in June. That would be the 15th of June, and the yield then got to 3.5%. So we backed up to came back down to about 2.75% early this week, and then the yields have risen since then. I don't want to get too far into the weeds with that. What's been happening, I think, let's go back to the fall of last year, and the central bank, the Fed, was jammed with this term of transitory. You know, the interest rates are rising, but don't worry, it's a temporary thing, and first thing you know, we'll be back down to low inflation. But the market didn't agree, and the forward markets, we trade futures contracts for different dates out into the future. So if you had a bet on where interest rates were going to be 6 months ahead or 12 months ahead and so on, you could do that, and those prices showed up. And of course, the people that are betting, are the world. And the market was right. The market saw that interest rates were going to go higher, or going to have to go higher than what the Fed saw. So interest rates really started to trend higher late last fall, and the rate of change just increased and increased as we went into the first half of this year, right down to the middle of June. And as that was going along, the Fed started to change their tune from transitory to, oh my gosh. And then started to, Powell used the term unconditional to describe how they were going to be about fighting inflation. Like they were going to throw everything at it. They weren't going to back down, to use a more colloquial term. So they were just going to keep cranking up interest rates, the only real tool they had other than quantitative tightening, until, the market cried uncle. And I had written in my blog a couple of times, will the Federal Reserve throw the stock market under the bus to try to fight inflation? My answer was absolutely they will. That would help them get the demand destruction that they want. Pardon me, when I say they want, that sounds like they're mean. What they think will cause inflation to go down. Now, this week we had the employment reports in Canada and the United States. We're seeing wage gains year over year in both countries are above 5%. In both countries, we've got unemployment rates, as they officially count it, at multi-decade lows. So, the central banks are going to keep raising interest rates. And that's the kind of the thinking. And the worry, of course, the last couple of weeks was that by doing that, they were going to just drive the economy right into a recession. Like, be careful what you ask for. So the reason we backed off, I think, from the 3.5% yield down to 2.75% on the 10-year was exactly that. These guys at the Fed who have made it clear that what their targets are, as long as employment stays so strong, they're going to continue to crank rates, and we're going to take the country right into a recession, if we're not already in one. So, and the same, by the way, applies to Canada. We've got a scheduled meeting of the Bank of Canada coming up this week. They'll be raising rates by 3/4, if not more. But they'll probably stick to 3/4, because if they went to a full percentage point, then the market might get the idea that they're panicking. But I think they're going to raise rates by 3/4 or more, and they will keep raising rates, as the Americans will, until, like, they see the whites of the eye. So that's what's going on there. There's kind of two markets, in a way. Or two worlds. So there's the world as the Fed and the other central banks and all the people that work there see, and then there's what the market sees, and those two things aren't jiving. So interest rates have been trading those markets has been wicked, like everything else, in terms of the relative speed or the delta of the moves. But I think that's kind of the key of what's been going on there.
The leading American stock indices hit a 19-month low in June with the S&P down about 26%. Markets have rallied since then. Do you think we've seen the low for the year and things are going to improve?
Short answer is no. I'd like to say yes, just because, I don't want to be the dull or whatever, the guy that threw the cold water on things. I think, and I will say this, just to put things in perspective here. I've gone into the weekend long the S&P 500. Now, it's a small position, and I could be out of it in a heartbeat once the markets are open again on Sunday afternoon if I don't like it. But I've been trading the American stock market from the long side, I guess maybe starting late last week. And I'm a very short-term trader with those trades. Sometimes if the trade keeps working, I'll stay with it, but there's been such choppiness lately that I don't seem to stay with my trades more than a few days at most. But I am buying it here because it seems so beat up and it's having a bit of a bounce, and I like the way the charts look to me. So as much as I think there's still a lot of negative news out there in terms of the environment we're in, and that could take us down to lower lows yet in the stock market from a short-term trading position. I have a tiny I'm just trying to explain this, like, don't go out and buy the stock market just because I said I'm long. I could be out of it really quickly, but yeah, I don't think we've seen the low for the year. And again, I said earlier, I do not believe I can see the future. So I just that's how I feel. I could have a strong opinion about the market. I just, don't hold that opinion strongly. What's the old expression? Strong opinion, weakly held. I don't think we've seen the low in the stock market for the year, and I could be wrong about that.
You've been trading markets for nearly 50 years and still actively trade your own accounts in the futures market. Given the recent wicked short-term price action, what advice would you give the traders and investors listening to us?
My advice probably gets a bit old hat, but it's always risk management is just way more important than pretending, and that's all you're doing, that you know what's going to happen. You get somebody that comes around, like in the old days of the Vancouver Stock Exchange, the whisper would go around that so-and-so was going to promote a certain stock, and for sure it's going to go up, and people would buy the stock and it'd go down, and you realized, you were just buying the stock that the promoters were selling. Now, I'm not quite that cynical. I think a lot of analysts that look at the market and give you an opinion, they really are doing their best. They're trying to do a good job. But I'm also aware that there's a hell of a lot of bullshit artists out there that are just writing marketing pieces for one reason or another just to try to promote something. So, just don't believe stories. And you have to believe something, I guess, but just be prepared that you could be wrong. And how do you prepare to be wrong? Well, the worst position, I guess, to get into is if you bought something and suddenly you can't sell it. The market just isn't there. There's either no bid in the market, or they closed the market, or whatever. But barring that, let's say you can get out. Over the years, I had hundreds of customers, and I had a lot of brokers that worked around me, worked for me, and I was able to observe hundreds and hundreds of clients lose millions and millions and millions of dollars. And the one thing a lot of them, nearly all of them, had in common was that they wouldn't take a loss. They bought something because they believed a story of some kind, and when it went down, they just dug their heels in and ultimately, would go down with the ship. So I just never do that. I talked to a good friend in Chicago this week, a guy we've known each other for 30 years, and he knows, and he used to work on what we call a prop trading desk in Chicago, trading private money, and for the last 20-some years he's just traded his own. And he said, just talking to his buddies, that everybody was trading the smallest size they've traded in their career. The liquidity is just not there. The uncertainty is just who knows. The short-term price action is so choppy, as we've just said time and again here in this interview. So this is not a time to be swinging for the fences or to be a hero. You want to trade, trade. Just be prepared that you might be wrong in your trade, and if you're wrong, don't stand around, wait for things to get better. Get out. Like I just said, I bought some gold on Friday, and I was actually ahead on the trade a little bit. I thought, okay, I like this, and then I thought, something just doesn't. I think I'm just I'm feeling lucky or something like that. I've made some money lately, so I think I know what I'm doing. And I just took the trade off. I thought, if I look at this on a daily chart, I'm buying the lowest price this is traded at in 10 months. And this is a dumb thing to do, so I want out. So I can buy it again next week. Jimmy, I think the key thing here is just keep your size small. Just be prepared that you could be wrong on whatever it is you're getting into. And, live to play another day.
Victor, thank you so much for being on This Week in Money.
Jim, it's always fun to talk to you, and I look forward to doing it with you again in another month or so.
My guest has been Victor Adair. His website, victoradair.ca. Coming up, Rick Ackerman, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Rick Ackerman, founder and editor of Rick's Picks online at rickackerman.com. Rick, welcome back to This Week in Money.
Always a pleasure to talk with you, Jim. Thanks for inviting me on.
Rick, before we get into details here, can you just tell us a bit about Rick's Picks and the mechanical trade system?
Well, if you come to rickackerman.com, you're there. You can take I think it's either a free trial or a 30-day for a buck. Not a bad deal. And when you get there, be sure to hit for the trading room. I've got 2 chat rooms. One, the discussion is anything goes. The other is mostly trade related. I think it's the best trading room in the world. For a couple reasons. Everybody's on the same page, technically speaking. They use the same system, my hidden pivot method. And number 2, it's attracted great traders, and they're doing amazing things, very helpful bunch. They put stuff out, timely trade ideas that anybody can do. And some of them are expert stuff, but some any trader can get a handle on. And you have to come in the room to believe what's going on there, because it's just a great place if you like to trade or want to learn how to trade.
And so you were saying something about a special offer. How does that work?
Well, there's a free trial subscription. Or I think we have maybe two different offers running. One's a buck for 30 days, and one's a freebie for I think a couple weeks. But if you just go to rickackerman.com and you click trial subscription up at the top, you'll get there, and you'll have access to all of the features and amenities of the website, which again is rickackerman.com.
Rick, inflation versus deflation. Your thoughts on that?
Oh, I love where we are now, because I've been kind of hardcore, I've been hardcore deflationist for probably since C.V. Meyer's book, The Coming Deflation, which had a 1976 copyright. So I guess that puts me in the deflation camp for close to 40 years. And until very recently, I haven't been wrong, or had not been wrong, but I don't think I'm going to be wrong anyway. I think inflation has run its course. It's about to choke itself off, as anyone who consumes things, meaning all of us, will recognize by now. When you try to extrapolate out inflation over the next few years, or or let's say the corollary of higher interest rates, you can see that we're already there. We've got enough inflation to snuff consumption almost completely.
What are interest rates likely to do if we're going into a deflationary period?
Well, I think we may have talked about this. I tried to give a very respectful dissenting view to something Martin Armstrong has been saying. I would make clear that I have a lot of respect for the guy, and he's got a lot more patience than I've shown as far as waiting for horrible things that we all knew were going to happen. So he's been pretty good, very good on long-term cycles. But I think he's calling for, he said interest rates have bottomed and that they'll be rising for the next 12 years or something like that into the 2030s. I don't think that's possible. I think that they can continue to rise in real terms, meaning if we have, let's say, a rate that's more or less hovers at 2% for the next 10 years, but it's in the context of a deflating asset base and in the context of deflation, then in real terms, that 2% interest rate will get higher and higher. But Martin did not say that. He didn't make that explicit or even implicit. He just seems to think that nominal rates will keep rising. But you and I have talked about a target at 3.56% on the 10-year. And it's a little too early for me to say that I hit a bullseye there, but it got up to 3.48% on the 10-year. So I was very close, and we've had quite a rally in Treasury since then, and a corresponding decline in interest rates, which move inversely with the bond prices. So it's possible that my 3.56% prediction on the 10-year did actually nail a very important high.
What's the U.S. dollar likely to do if we hit a deflationary period?
Well, you can sort of back up on that question. The one I put out to all the experts who are obsessing over inflation, it's such a horrific drumbeat at this point that I don't want to seem impolite, but I'm just asking the obvious question. Well, how does this strengthening dollar, how does that tie in with your inflation till the end of time scenario? And the fact is, nothing could be, a stronger dollar is a reflection of deflation. And that's what we're getting. In part, it's occurring because even though the dollar fundamentally is crap, all the other currencies in this world are even worse crap. So that's one of the things that's strengthening the dollar. And of course, when you have that, when that's happening, you're going to get an increasing flight to safety into dollar-denominated assets, namely treasuries. So this barbell that I've been talking about for a couple of years, your hedge against the worst possible scenario you can imagine, it puts treasury paper against gold. And we were holding off on the treasury side until we hit that target, 3.56%. But I also think that it's a good time to be loading into gold too. And I say that partly acknowledging, trying to play contrary to my own gut instincts. I hate gold. It's been so rotten. It's been so miserable toward gold bugs and the people who love it, investors who love it, that maybe it really is time for a turn. So I think the barbell is really where you want to be. And of course, historical precedent says that you'll never go far wrong buying, as an investor, buying the stuff that everyone hates. So I think gold and treasuries are pretty well entrenched in that category right now. So what can you lose?
Is deflation good or bad for debt?
Well, deflation is the kind of ruinous consequence of debt. When you rack up a certain amount of debt, that, as we have, that can never, ever be repaid, it still has to be paid in one way or another. And I keep coming back to something that C.V. Myers wrote when at the time he wrote the book The Coming Deflation, with I think it was a 1976 copyright, the first edition. He made a very simple statement, very simple, that ultimately every penny of debt has to be paid, if not by the borrower, then by the lender. And I think that if you just keep that in mind, it will explain virtually everything that goes on in the big picture. You'll be able to understand kind of the macroeconomy and the financial sector economy and everything else. It goes to that inexorable rule that ultimately every penny of every debt must be paid. And the tricky part of it, and it's not really tricky at all, it's very simple, is that people somehow think that, let's say when you rack up $1.8 trillion in student loans and we give the students a free pass, the misunderstanding there, and this is almost universal, is that, well, see, we forgave the debt and nothing happened, nothing went wrong. Well, the fact is, every penny of that 1.8 trillion, if it wasn't paid by the students, it's going to be paid in very real dollars by the bondholders who loaned money so that the students could go to colleges and universities. So same thing, you can't make your mortgage payments anymore, and you leave the keys in the mailbox and you walk away from the debt. Well, the debt still, every penny of it will be paid by the bondholders, by the mortgagors, the lenders, all right? So, and probably the most pernicious and kind of biggest picture thing that nobody sees is that we have a Social Security system that's bankrupt. If you just play it forward a little bit, and it's only the fact that it's living off the fatted calf that we don't think of it as bankrupt. But all those pledges, those commitments, and it doesn't have to be Social Security. We could talk about the contractual promises of the state of Illinois, for instance, for one, to pay its employees a monthly sum as a pension. All right. Well, that they're eventually going to default. Illinois, I'm guessing, will be the first state to default on its pension obligations to public employees, and of course, the misconception here goes in the direction of saying, well, the federal government will bail them out. But whenever we use the federal government in that context, I always say substitute the word taxpayers, all right? So we'll have the taxpayers bail out the state of Illinois, and you can see that can't possibly happen. It's one thing to inflate financial assets in real estate, but it's another to send out $1,800 checks to 3,200,000 retirees every month. So if you start bailing out 20 other states, then yes, you are on that hyperinflationary track that I've said we're never going to get to. But anyway, so it's really simple when you think we're not escaping debt. Every penny of it will be paid, and even obligations, liabilities within the Medicare system, we're going to pay for that. Even though we can't afford it, it will be paid in reduced services. There will not be all the artificial hips and bypasses and artificial knees for the baby boomers as their parents received. All right, so everything we're going to pay for every dime of it in one way or another.
What could all of this mean for real estate?
Well, real estate's in a state of, let's say, incipient collapse. It's odd because I think I just read somewhere where the average price of New York City real estate was the highest ever, but the transaction volume had kind of dropped over the falls, and any idiot can see what it is. None of us is going to get out of our house with a big profit and just retire to Tahiti, because we really don't have anybody to sell these homes to. Mortgage rates have effectively doubled as home prices continue to hover near all-time highs. So basically, you just have a relative handful of properties trading to set values at the margin, but we shouldn't kid ourselves that these insane real estate prices are going to be sustained. It's going to be part of a deflationary collapse, and to the extent that a lot of borrowing has been done on real estate assets, that's part of the deflation that's coming.
people using their houses as ATMs instead of an investment.
Yeah, and the refi machine that helps that along is no longer it's no longer the old fusion reactor, because it's one thing to be doing refis all the time as rates come down, but they've gone up quite a bit, and so the refi market's dead, so that ATM effect isn't getting much play. And if you sort of extend what's going on into the recession, that it's really funny the way we play these statistical games, and you'll have someone like Krugman or some other like blind, deaf, dumb idiot on the op-ed page kind of debating whether or not we're going to have a recession or not. Well, those of us who are like in the real world, we absolutely understand that the recession has begun, and that for all the fakery of the booming, supposedly booming economy, at the ground level, we're in a disaster already, because just look around. So many retail places have closed. The travel and entertainment industry is on its butt, except for the fact that, yes, people are driving places this summer and staying in motels, but they're horny enough to kind of skew that statistic in what looks like a bullish direction. But the recession that we're in, that's going to keep getting deeper and deeper, is not going to be like any other, because we have so many people who have left the workforce, and I gather that most of the young ones are being supported by their families. We've also imbibed a huge population of immigrants from Central and South America, and whether or not we want them or we should be letting so many in, we're really responsible for them in this economic downturn. So if the social services system that has functioned to entice them all to come to the United States is going to continue to work at all, it's going to require enormous transfer payments to that the population of let's call them, this is politically correct, but let's call them illegal aliens. But it's going to be concurrent with the disaster in let's say the native population, because the real economy, people working behind counters, waiters, people who work on cruise lines and things like that, and the ones who have lost their jobs at banks because AI has put so many tellers out of work and everybody else. Well, this isn't going to be your grandfather's or even your father's recession. It's we've got an out of work population that's huge. So this is going to come to bear. Well, it's going to be a while before you're reading about it, but it's certainly a known quantity to people who are out there, maybe renting places that they can't quite afford. Some of them with money received with the government handouts over the COVID period. I guess that's been kind of frittered away. But you just look anywhere, and it's not ripples. It sort of radiates out. It's a tsunami that's coming, because the landlords, like BlackRock and some of the other huge players that got into spec housing, they're going to get crushed, because they've got no one has even thought for years about how important it is to have good tenants. But good tenants are going to be at a premium in this recession that we're in now.
What do you see ahead for the price of crude oil?
Well, it's kind of amazing that it can rally at all. I guess one of the phony stories, the will-o'-the-wisp hopeful stories, is that China's manufacturing economy is starting to show a little bit of life. But considering where the world is right now, I don't expect China's manufacturing to burgeon. And, of course, a burgeoning Chinese manufacturing sector is what pushes crude oil prices higher at the margin. So sort of looking at the real world, I can't fathom. I see oil coming down way, maybe below $50 a barrel again in a global recession.
What do you see ahead for natural gas?
Well, I would say same thing, but we've seen that natural gas is just one of those. It's such a rigged game that we've seen whole winters when mild winters combined with, enormous supplies coming from new fracking developments in Texas and up in Nebraska and other places in the Dakotas, and the prices still don't come down. It's like everybody's gas heating bill goes up in the winter when they're in a perfect situation with respect to supply and weather and everything else. So yeah, natural gas prices will come down as well, but maybe not as precipitously as oil, where I think you've built out a lot of leverage, a lot of speculative action is tied to crude oil resources.
How is gold likely to perform in a deflation?
Well, I've never had to change my mind about this. I think that gold, relative to all other classes of investable assets, is going to do just fine. It's going to hold its purchasing power. All right. I'm not a gold is going to 5,000, let alone 50,000 kind of guy. It might even come down in price. But I think it'll be, if you hold gold, you're never going to go wrong in the worst of times. So yeah, I don't see necessarily a big rally in gold's price, but in terms of purchasing power, I'm absolutely confident that it will hold up just fine. The mining stocks though are regardless of what physical does, the mining stocks are really taking it in the chin and seemingly without the ability to rally. And if you ever have visited a mining site and you see how energy intensive it is, it takes massive machinery and huge energy inputs to get gold out of the ground. So they're getting killed. And of course, in a normal world where supply and demand eventually give you an equilibrium price, in this case, although it's predictable that the supply of gold will dry up as it becomes, as the energy component for getting it out of the ground keeps going higher and higher, or the cost of it, but reduced supply is probably not going to overcome the forces that manipulate the price of gold on paper. Probably the sleaziest operators in any market in human history are probably the bullion bankers. So, and the things they do are amazing. The short positions they accumulate, which ordinarily would be fatal, they somehow manage to maneuver the market so that they can cover the short positions at great prices. So bottom line, the production of gold is probably going to fall off quite significantly, but it will not have a corresponding impact on the price of gold.
How's silver likely to perform in a deflation?
Silver will be great, I think, especially if we have the disaster that nobody can even imagine. Meaning this recession will be worse than anything we've seen since the 1930s. But silver is always it's divisible into small increments. You get a bag of junk silver, and I think eventually it will function in a barter economy that may be coming.
What is a deflationary depression, and what would be needed to make one happen?
Well, the main thing that's happening right now to bring it about is a stronger dollar. And again, I challenge all these yo-yos who are obsessing about inflation till the end of time to explain how this dollar that continues to get stronger and stronger fits in with their pat little scenario. The dollar index is trading at 107 right now, and I've got a target up. It's traded almost to 108 recently, and I think it's going to test the highs from a couple decades ago near 120. So the strengthening dollar, in theory, it should produce a benefit for U.S. importers of energy, because we're paying for imported gas or oil in dollars, and of course the strengthening dollar reduces the real price to U.S. consumers. However, and correspondingly, all the foreign countries that pay also for their oil in mostly dollars, they're really getting hit pretty hard. But I think that whatever benefit we might enjoy from having gas prices be, let's say, less insane than they already are, meaning if the dollar were weakening, we'd maybe be at $10 a gallon already at the pump. But I think that's more than offset by the debt side of deflation, meaning that the cost of servicing debt in dollars is increasing as the dollar it goes up in value. So that's affecting everybody in the world, especially in the U.S., where personal borrowing is relatively high. We've sort of perfected that way of stoking consumption in this country. So debt deflation is really just instead of defining inflation and deflation as the idiots do, the monetarists, they say, well, inflation is an increase in the supply of money and deflation is a decrease. That yo-yo idea stopped being useful 20 years ago. There's so many fungible forms of money that nobody can even begin to measure it. So when I instruct people as to how they should think or about inflation and deflation, you should see deflation very simply by its chief symptom, which is an increase in the real burden of debt. And at the level everybody can understand, we saw that in 2007 and 8, when even with relatively low mortgages in the 4 or 5% range, low at that time, mortgage borrowers were experiencing that crushing burden because the value of their collateral was decreasing in value. So we've all seen that, and we saw it occur in a market that was never supposed to drop in the way that real estate did over that period. So we're going to revisit that, and I think the next drop is going to be much worse. And you'll see that even if you've got a 3% mortgage, it's going to become quite a problem with, let's say, the price of your second home, your vacation home, losing maybe 90% of its value.
It looks like the Bank of Canada will raise its rate 0.75 of a point on July 13th. Do you think the Fed will continue to raise rates?
They don't have to. The economy has already had the life crushed out of it. And, to talk about needing more rate increases, it's ridiculous. It's kind of a static analysis that suggests we could use more rate raises, but where we are right now is enough to snuff the global economy and put us into deep freeze.
Have Canada or the U.S. previously experienced a deflation?
Well, the U.S. certainly did in the 1930s. And I think in the post-Civil War period with the panic of, 1873, and Canada had a bit of a deflation problem in the 1920s when things were going great guns in the U.S., and Canada had a full-bore deflation, I think, with maybe a 25% decline in asset values in the 30s. So deflation, and I think very recently Canada may have reported a falling consumer price index for a month or two. I wouldn't call that deflation, but let's say it's an early symptom.
In a deflation, are there any safe places to keep financial assets?
Well, as we've discussed so many times over the years, really, treasury paper, and at this point, gold. Most people think gold, if the dollar falls in value, that's when you should hold gold, but gold historically has done very well in deflationary times, so that's where I think you got to be. And I think the time is now, gold versus longer-term treasuries.
Zimbabwe, a country racked by inflation and poor governance and everything, their banknotes are in the billions right now, and they say to fight inflation, they're going to start issuing gold coins. Is that going to happen elsewhere? Or if inflation comes to a halt, will gold still be important to currency?
The only way to get back to honest money is with a peg to gold. And believe me, the way back is certainly not through cryptocurrency or any shape, form, or Bitcoin. So the problem is that so many countries live by their exports that any country that says, well, we're going to be hard money again, they'll export nothing. And I don't really know what Zimbabwe's export economy looks like, but they're just kind of going through the motions of saying we're going to do something that has the potential to exert control or reassert control over our money system. But no, Zimbabwe's not going to get things under control.
What tools do you use to analyze markets?
Well, I use ABCD patterns on a chart, and you think, well, how much can you get out of something so simple? But it turns out that if you watch ABCD patterns very closely, hundreds and hundreds of thousands of times over 20 years, you get to the point where you can see things happening. You begin to find answers. You stick with any system, any trading system certainly. The best purpose of it is to essentially fix your observations, and it's only when you fix them for a period of time that you begin to learn. So I use purely technical analysis, and sometimes it creates difficult problems or even quandaries. Like I'm looking at crude, and as we discussed earlier, unless China and the global manufacturing economy spring back to life, which I would rate that as almost as an impossibility, crude prices are going to languish. But at a purely technical level, when I look at a chart of crude, I see the recent, and I forecasted it as well, the recent dip below to 94 and change as a buying opportunity on a long-term chart that projects crude prices as high as $130 a barrel. So we're at 105 right now, and for the life of me, I don't know how crude could get to, could have that kind of increase unless it comes from some exogenous shock generated by a geopolitical event that we don't want to imagine.
Rick, how can people sign up for your free trial offer and subscribe to your products?
Well, I'm glad you asked, Jim. If you simply go to rickackerman.com, up at the top of the page, let's see, I think something will come up. You'll get like a pop-up at the bottom that you click on to get a trial subscription. And let's see, I can't bring it up on my own page because I'm logged in as a subscriber, but let's see. At the top there's free resources. If you just take that tab, you mouse over the free resources tab, and at the bottom it says free trial subscription. So if you go to rickackerman.com, that's where you get it. And again, head for the chat room because it's the best. It's the best you're going to find anywhere. It's just a really great bunch of traders, very knowledgeable and very helpful in the way of giving relative novices something to play with.
Rick, thank you so much for being on This Week in Money.
Well, thank you very much again for having me on, Jim. It really is a pleasure to connect with your audience.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, and Rick Ackerman. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.